Good afternoon, everyone. Good evening. Good day. Um, Hello. If you can hear me, hello. Let me know. Um, Jenny, already in the chat. Looking forward to this. Would like opinions on VG and on Nvidia, if possible. Jenny, love your style, but can you tell me what you mean by VG? Love opinions on VG on Nvidia. Not sure what that means, but let me know in the chat if you are watching live, Jenny. That would be very handy for me. So you can be joining us live from basically anywhere: Facebook, YouTube, that thing called X, many different places. You can just jump in the chat and say g'day. Normally we do roll a bit of a video at the start with our disclaimer and so on and so forth, but turns out that's been coming through a bit patchy lately. So you're going to hear the disclaimer from me. G'day, Tash. Good to see you. Thank you so much for letting me know. So we'll be going through investing in US stocks from Australia. If you own US stocks, however you invest in the US stock market, let us know. Let me know. What do you do? How do you do it? Maybe you can, and then come over and run the live show. That'd be great. No, just kidding. But let me know how you do it. Josh, you've said cheapest fees for US stocks in Australia is Interactive Brokers, I believe. Yes, I believe that may be the case, Josh. I don't know about Interactive Brokers. I used it in the past, but what I hate is account fees. And also, when I talk about investing, I don't like the minimums that some of the brokerage firms talk about. So another thing I don't like, and this is not necessarily a pushback to Interactive Brokers, Josh, but just in general, another thing I don't like is when the brokerage platforms are very opaque with their FX. So when they transfer currencies around behind the scenes, they transfer your money. Are they being fully transparent with what they're giving you, how much you're paying, and the spread that they're collecting? And finally, another thing that I look for in the brokerage firms that I use, and all of the investing firms, and all of the brands that I use in my life is, does this help me do the thing that I'm trying to do better? Does it help me be better at the thing that I'm trying to do? And many of the brokerage firms, in my opinion, are built as trading firms, not as investing firms. I think there are only a handful in the world that I would call investing platforms. The rest I would call stock trading platforms, if that makes sense. Okay, so Jenny said, a blunder, my phone has a mind of its own. Okay, so let's jump into it. G'day, Jackie, Angie, Tash. We have a few slides to get through. A bit of a quote that's a bit different this week. So this is I'm going to test myself, fourth installment of the new Rask Invest live show. And the first 4 or 5 episodes of the live show are all about like building foundations. So we go live every Thursday at 12 noon. That's on the eastern side of Australia time. But we will come back next week and we'll do buying property in Australia. And once we've done that one, then we will roll on with building our Navexa portfolio that some of you know, which is maybe going to be called the fake news portfolio. Who knows? We could call it anything, but that episode and the fake news will be in 2 weeks. So we'll start building the portfolio again from there and see how we go. But don't forget, you can get all of the updates via the Rask community page. Okay, so Navar, good to see you. Navar, founder of Navexa here. He built this thing. Caught up for a lovely breakfast with Navar this morning. So this is all available right here. And we're going to have Navar on the show in the future to explain how tax works, in particular, not necessarily tax generally, but just for investors and how you can use things like this. And you can add benchmarks to your portfolio. So for example, one thing a lot of investors don't like to do, but probably should, is when you have your portfolio set up in a piece of software like, say, Navexa here, you can click edit benchmark, and then you can basically compare your portfolio to a standard benchmark or any benchmark of your choosing. And so obviously our fake news portfolio only has one ETF in it at the moment, which is the AAA ETF, the cash ETF. And we've only been running it for under a month. But you can see that our portfolio has returned positive 0.26%. And meanwhile, the ASX 200 ETF from Spider, SPDR, is down negative 0.45. So, in fact, what this concludes is we're geniuses. That's about it. That's all we can conclude from this wonderful chart. No, just kidding. But seriously, this is a fantastic tool. If you already have your portfolio set up, you can see what's contributed to your returns, what's pulled your returns down. You can also see income versus growth, and you can also see against any benchmark of your choice. So you could compare your returns to, say, a Vanguard ETF or to a individual stock or whatever the case may be. So yeah, this is really cool. We'll start using this in the future. Shout out to Super Guide, also one of our supporters. You'll find links to all these goodies in the show notes. This is Pocket Smith, which we use for budgeting. This is, oh, here we go. Look at this. This is from Perla. I didn't even know this thing was here before. I just literally logged in and then turned on the live show. Want to personalize your portfolio with brands like Apple, Nike, or Tesla? Adding US shares and ETFs can be beneficial due to the broad range of opportunities, global reach, and dividend and growth potential. Huh. I had no idea. This is not, I think, unless Perla knew we were going to talk about US shares today. Let's explore that. I did not know that this was a thing. So there you go. So we'll come back to that in a minute. And that's about it. So let's get into the show. Stuart, thank you for your question. I can get to that in a moment. Buffett's quote is, the difference between successful people and really successful people is that really successful people say no to almost everything. I definitely see that, and sometimes it annoys me, but as you become better at something, oftentimes you'll find that you do less things that distract you from the core thing that you're trying to achieve. For example, what you'll find with most really good individual investors is that over time they do less and less and less, and they have none of that shiny object syndrome, which we're all, attracted to. Things like, I'm going to go and buy this really exotic share in this really strange market on Interactive Brokers. It's like this Zimbabwean mining company. And the less and less you do that, the better you'll probably be over the long term, because you just get better at knowing what you're good at, and knowing what you're not good at is a much bigger thing. And I'll come back to this quote throughout today's live show. If you haven't already subscribed on Twitter, YouTube, or Facebook, subscribe, because you'll get notified every time we go out. We've got almost 30,000 YouTube subscribers now, which is funny because we've got almost 30,000 students in our free courses. So it's like a race to 30,000. Either way, both of them are going to hit 30,000 in the next week or two, which I'm really excited about. So I said that we would do the general advice warning. Remember, anything that I mentioned today is strictly general in nature and does not take into account your needs, goals, or objectives. If you want personalized financial advice, you should seek the advice of a licensed and trusted financial planner who can take into account your needs or goals. Rask Invest is actually the name of our investment service at Rask. So if you invest with us or with me, that's called Rask Invest, and that has its own product disclosure statement, which is available on our website, as well as a target market determination. Basically, every investment service in Australia has one of these. The key difference between the two documents, if you're like, that sounds like finance gibberish to me, this tells you about the thing that you get. So like if you have insurance, it tells you what's covered in insurance. But this thing right here tells you who the product is suitable for. So for example, if you go and you look at an investment thing and you're like, this sounds pretty good, but is it designed for someone like me? You can now go to the website of that provider and check out this thing, which is a really simple way to understand what it was built for and if it might be appropriate. So that's a kind of easy way. You don't need to get financial advice. You can try to, well, unless you need to, of course, but you can actually use that to kind of get a good gist of if it's designed for someone in my situation or not. The format, obviously, it's every Thursday. I've already said all this stuff, so we don't need to hang on it too long, but you can jump into the Rask community and ask questions and keep that going. But today we're talking about why you should consider US investing from Australia, the long-term performance, how to invest in US stocks from Australia. Josh has already mentioned one of the brokers, which is one of the leaders here in Australia. I'll give you a bit of a stock investing checklist. I've also got someone that you should follow if you want to go ahead and keep doing individual stock investing. I will explain the currency impact of long-term investing and how to think about it. And I'll share some of my favorite US stock market ETFs and, of course, answer your questions. Justin, you've come across and you've asked this wonderful question, and I will answer this right now because you have come across from the Rask community and you've talked about this post, which was put up by Clary here, and there were a few people commenting about the change in the Global X ETF. So the Global X ETF N100 is now U100, and there was some speculation in the comments about this change in the ETF and what it actually meant. I'm not concerned in any way, by the way. I know there was some fear about the change of this ETF because this is an ETF that invests in some top 100 US shares, and there's a few criteria and whatever that go into it. Um, I'm not concerned because and the CEO also announced recently that he's stepping down. He'd been with the company for many, many, many years. Not concerned at all. Um, so yeah, I just wanted to make that apparent. I'm not concerned in any way. And this change in the index can happen all the time. So ETFs track an index and they can change for various reasons, whether it's licensing, whether it's a change in the kind of research that goes into it. They want to adapt it. That's happened many times over the past few years, including with other global X ETFs like their dividend ETF. Some ETFs can close down and they'll tell you that it's going to close down and they'll send you your money back and do all that sort of stuff. That's very common, particularly in the United States. And so these things tend to happen for different reasons. Now, I don't know exactly the reason why this had changed, but I'm glad that Clary put it up here and kind of showed us that they're very similar in the way they're built. Obviously, the NDQ ETF from BetaShares tracks the NASDAQ 100. So U100, it has quite some changes, but ultimately it looks pretty similar in the makeup, but still quite different. And then there's the IVV ETF here, which is obviously you can see much more diversified. It's got less holding in Apple, Nvidia, Microsoft, and so on and so forth. So it could have been a licensing thing, could have been just a change in the way they research the US market. Yeah, I hope that makes sense. Sorry, I don't have a specific answer for you. Okay, let's get into the slides that I've got, and then we'll race through that and get into some questions. So most people know that the Australian market is quite a small stock market. And if you look on this chart, this is from Visual Capitalist, an absolutely wonderful website, which I'd highly recommend you go and check out because they put all the data into charts to make it understandable for humans like you and me. So if you look here, what it actually shows you is kind of the makeup of the globe as a stock market. And you can see the US, based on their methodology for understanding this, is 42.5% or was 42.5% of the entire world last year in 2023. Now, in their actual report, you can see here Australia is only 1.5%. So in terms of how this diagram is constructed, I don't think 1.5% is actually in proportion because it would actually be smaller than that, especially because Singapore is so much smaller at 0.6. You can see the next biggest after that is the EU and China, EU being a collective series of stock markets. But what's interesting is that I didn't include it here, but what it also shows is that in their chart pack is that the US stock market as a percentage of all stock markets is actually forecast to decline. So over the next 20 and 30 years, it's actually forecast to become a smaller portion of the overall stock markets throughout the world. And I think that's just because the entire world is becoming more, democratic and capitalistic, and realizing that the stock market is actually a great mechanism for society to redistribute wealth, for people to be rewarded for innovation and for pushing their societies forward. And so we'll see that happen over the next 30 to 50 years. Whether or not, in my opinion, like the US actually becomes that much smaller, I'm not 100% sure because that's a really hard thing to predict. But what this chart basically reminds most people is that we're only a small slither here in Australia. So how do we get access to other things outside Australia? I'm recording this live show right now from home using an iMac. And that's great. That's one of the most expensive things in this room. It probably is the most expensive thing as I look around this room. A bunch of the books on the shelves behind me are written by US authors. It's funny that this microphone actually here, you might be able to see it. This microphone is actually built by an Australian company. So this is one thing that's Australian, but basically everything in this globalized room around me is built overseas. There might be a couple little bits and bobs here. I've got some Chinese made like lights for the studio here. And I've got a Dyson vacuum, it's probably made in China, designed in the UK. And the idea, as you look around wherever you are right now, you might be in the car, you might be doing whatever. Chances are this chart here is probably indicative of how you live your life. a lot of the things that you're spending money on or the brands that you recognize will be from the USA. There would be a lot of stuff in your house that's made in China, but it's probably not the high ticket, like the high value items. There's probably stuff in there that's from Japan. There's probably things in your house, maybe more in your pantry than in your studio or your office, that are made in Europe, and these types of things. And so, basically, what we know is that the US market is dominant, and global markets in particular shouldn't be ignored. So I'm just going to pop this on the chart on the page here, and I'm going to ask you just in the chat. There's two different ETFs that we have here. One is an Australian ETF, and one of them is from the United States. And it shows the breakdown of the sectors of that stock market. So now we've zoomed in, we've gone zooming in, and now we're looking at the stock market as a whole. Which of these charts on the left or the right, more tables, which of these is USA and which of these is Australia? Just based purely on the data that you can see in front of you. Which one is it? Left is what, right is what? And I'll give you a hint. There's only the USA or Australia. So that's all you're choosing between. So 50-50. You don't need to phone a friend on this one. But have a guess. Which one is Australia? Which one is the USA? Jeremy, you've said Australia is on the right. Left is US. Thank you, good sir. Aussie on the right, says Matthew. Anyone want to tell us why? That'll be great if you do have a moment. I will not confirm whether you are right or wrong right now, but we can just wait. And if anyone wants to say why, left is US, right is Oz. This is QA. Left US. Okay. Good. It looks like, yeah. Okay. So it looks like we're all on the money. If this was Who Wants to Be a Millionaire, I think we all just won. So that's great. Thank you, Paul, Steph, JJ. So many of you will know when you look at this chart, Angie, you said US is on the left because healthcare is so high. Yeah, that's actually an interesting way to look at it too. So we've got healthcare, says Angie. And if we look at the Aussie market here, so you were correct. This is Aussie. This is USA. Now, so we can see some differences here. Boom. Another massive difference is this one here, which is IT. The reason why it doesn't say IT here is because this sector kind of falls in a different bucket over here. But basically that falls in here. So you can see that's probably the most pronounced difference is that one. Financials. So obviously in Australia, we've got the big four banks. We've got Macquarie. We've got things like Insurance Australia Group, Suncorp, those types of things. In consumer discretionary, we've got in the USA, you would have things like Home Depot, Costco maybe falls into this. Maybe it's more consumer staples, but that kind of a thing. Amazon probably might even fall in there depending on how they cut it up. Consumer discretionary, you can see that there. Staples, I think consumer discretionary in this instance might also include Woolies and Wesfarmers, to be honest. And it goes on and on and on and on. And basically what you can see in Australia is if you just took the top three, how heavy our market is in just a few sectors being really cyclical industries like iron ore, coal, copper, and also in the banking sector or property. So we've got huge exposure here. Whereas in the US, they've got more exposure to things like Microsoft, Nvidia, Tesla, these types of things. Healthcare, they've got great brands like Johnson & Johnson. They've got United Healthcare, these types of things. Financials, they still have some of the biggest banks in the world, like Wells Fargo, Bank of New York, heaps of banks, as well as investment banks. So overall, though, you can see that this is probably more the definition that people would like when they think of the mix. Because as we know, information technology companies like Apple, Microsoft, Oracle, Amazon, these types of businesses, even though they have this category or sector, air quotes, reality is that they're really dispersed across the entire economy. For example, someone working in mining still uses a Microsoft Windows PC. or someone in, let's say, the utility sector designing power lines would probably use an iMac, right? So even though this is the biggest quote unquote sector, it's not really a sector because it's so distributed. It could be everything. Whereas in financials, you know that a bank is a bank, and you know that an iron ore miner is a miner, if that makes sense. Yeah, and so Matua, you've said tech on the right, banks mining right. Yep. Tech high on the left says Tash. Because of financials, yes, yes, yes. Everyone's now to Imi, you too. Okay, so basically, if you're investing, you can already see that just by having some US shares, you're probably going to have diversification because you're getting things that aren't as common in our home market. So you're getting some of those tech stocks, right? And we've seen this play out basically since the end of the Second World War, when Americanism, globalization, many different things started to take off around the world. And while the Australian stock market up until recently was one of the top performing, over the past 50 years, this chart, which I first referenced in Rask Invest Live number 1, and I think Rask Invest Live number 2, I could be mistaken. I don't know. I've referenced it already. This is the Vanguard interactive volatility charts. That's the fancy word for saying stock market and investment returns over time. This one here shows the US market, and you can see that through time, especially starting in the late 80s, this is a mid 80s was when Microsoft was founded, by the way. The internet really started to become a thing in the 80s and 90s. We had the dot-com boom right here. We obviously had the financial crisis and boom around there, property prices in the US. And more recently, we've had the emergence of SaaS companies. We've had the emergence of the cloud, AI companies, and the US has dominated all of that stuff. And so it's natural that we've seen the US market get way ahead. Now, there is also there are other markets outside the United States. For example, China, Europe, these ones which we referenced before, they're captured in this one, which is the Brown International Shares one. And one interesting thing here, you might have been able to zoom in better than I have, but if you look at this chart, right, guys and gals, if you look at this chart and you see the US is all the way up here and the rest of us are down here, what you would probably assume if you looked at this like we normally do with our human brains is you'd probably be like, wow, it's done so much better. So much better. But really, if you look at the yearly returns, the average returns, you will see that it's not that much different. So it's 11.9% per annum or per year on average, versus, say, for the international shares more broadly, which also includes some of them, it's about 1.8% different. It's about 2% different from Australia. But that 2% difference is over the long term this much. So it's this much right here, right? That's what you're basically missing out on. And so while it might seem like a small difference from one year to the next, over 50 years, that's a humongous difference. And there's a few reasons which we've covered in previous live shows, but basically it's lower fees, it's focusing on the things that you can control, it's making sure your portfolio is set up correctly so that you do have shares in your portfolio from all different parts of the world. So that if you get it wrong or if you get scared, you know that you're diversified and over the long term, you're going to capture some of those winners. But if you only had Australian shares throughout this 50-year period, you would be way behind someone that had at least some US shares. And that's probably the key insight to take away from that chart. If we scroll down, we've got to ask ourselves, well, why was the USA able to do this? And the answer is because companies in the United States have done this since the year. This is back, I think it's like 1870 ish, right back here, 1870. I'll choose a different color so that's the color of the chart. Yeah, right back here, I think it was 1870. What this chart shows you is that earnings growth rate, or just earnings, so I should take away the growth rate, earnings. So earnings is just another name for profit, but that's what they say in the US. They say earnings. They don't say profit like we do. Profit. Look at that. Mr. Squiggle would be proud. So profit. And what this chart shows is that the average company inside the S&P 500 in 1870, let's say it was then, I think that's about the year, the average company in 1870 was earning this much per share, but all this time later, now it's earning this much. So you know how people say to you, oh, the stock market's so high, it can't go any higher. Well, of course it can, because the companies on the stock market tend to get more profitable over time, not less profitable. And over time, while it doesn't work out every year, i.e., global financial crisis, i.e., Great Depression type periods, while it doesn't work out every year, over the long term, countries that have a culture of rewarding winners will, over time, become better societies and have more entrepreneurs and more people and more companies solving the world's problems. If you go back and you look at a chart like this for communist Russia, or even communist China, to be honest, which is probably still communist in many regards, you'll see that this does not play out nearly as well as this one does. And the reason is that it's not pro company solving problems, it's for society's benefit. So it shifts the mix. And of course, like, you could throw rocks at glass houses and all that, and you could, say that the US has its fair share of issues and it's a bit of a basket case. Absolutely, no one's perfect. But the idea from this chart is that what powers people's wealth is the stock market and other things, maybe like cash or property, but mostly the stock market powers people's wealth. And why does it do that? It's because society is set up to reward individuals and groups of people called companies that power our and push our society forward. And it's kind of like, people often argue that, or debate, I should say, that there's rising inequality in the world, and focusing on wealth through the stock market is kind of like a greedy person's thing. A really interesting way to think about this is, if it wasn't for this type of chart and this type of outcome for society, people probably wouldn't have refrigerators in the world. People wouldn't have television sets. People wouldn't have the internet. There just wouldn't have been the motivation from individual people to go and do great things. And that's ultimately, like, we can get into politics and all that another time, but that's ultimately why this chart works and why wealth is created by the stock market. Because people go out, solve a problem, and then that problem creates wealth for the people that solve it as a reward. And as shareholders, we can do that. And a good example of this is, if you compare Australia to the United States and you think about things like tall poppy syndrome, which is the idea that as soon as someone is quick to achieve wealth in Australia, or a business is quick to grow, a lot of people in Australian culture will be really quick to jump on them and shoot them down. That is the total opposite culture in the United States. If you go try something, you fail, that's actually kind of like a badge of honor. And it's like, oh, great, you tried it. Great. You can come work with us because you've obviously experienced it. Whereas in the Australian culture, it's very different. It maybe perhaps you could argue it was like that quite a while ago. But anyway, I digress. What are the top shares that are traded by investors around the world? So apologies, Navarre. I couldn't find this chart on Navexa, but if you have it, put it in the show notes for me. This just shows you from ShareSite some data on what are the most commonly traded shares. So this could be shares, ETFs, literally anything amongst Australian investors. Now, if you go through this list, what you'll see, this is an ETF, 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 this is an ETF. I'll come back to this one in a minute. This is an ETF. This is an ETF. I'll come back to that in a minute. This is an ETF. This is an ETF. So for people that don't already invest in ETFs, it's clear that the puck has skated past you, like it's slid past you, and you should be seriously considering the use of ETFs in your portfolio. And we're going to talk about that. We talked about it last week. But if we now take a different color and now we just look at US shares, so like global shares amongst the most traded, and you'll see that there's this one. This is in the month of July 2024, by the way. This one, that's for Jenny's benefit, that one, the first one there, and this one. And that is it. So on the list of, I don't know what this is, like 20, there are 2 US shares on that list. They're very frothy ones. We've got Nvidia and we've got Tesla. Probably the majority are ETFs. And then finally, we've got Australian shares like this. You can see in green now, apologies for those who can't see the color, but in green, we can see now the number of shares that make the list that are Australian. And this has been something that's been playing out for the past 10 years. We can see from this right here that most people are now using ETFs to build their core portfolio, at least if they're kind of thinking prudently about their future and how they want to spend their life. That's what they're doing. And they can see that, you can see that play out with all the red lines. You can also see that still shares like BHP, which is the biggest company in Australia, is pretty popular. It's at the top. Drone Shield, yeah, I mean, that's a bit of a specky one, but we can go further down. We've got Woodside Energy, which is the big oil and gas play. Fortescue Metals, which is iron ore, great dividend payer, but pretty cyclical. Pilbara Minerals, very much on the nose for lithium. ANZ Banks further down the list. This is just 1 month's worth of data, but I want to zoom out and show you one other thing that's really interesting about this list. And that's, yeah, I can use this color. That's the buys and sells. And you can see basically that there's this big chunk, and this is like this kind of area here. This is actually showing you that the majority of people are dollar cost averaging into these types of investments. And the most dollar cost averaged into, so this is where you just buy your investments every month. You get your pay or you get some income, and then you split a bit and you just put it straight into the stock market. You can see that like $9 out of $10. So 9 out of every $10 that's going into ETFs is going into a purchase rather than a sale, which is really quite interesting. Now, if we come down to this more speculative stock on this list, which is Drone Shield, a maker of technology to stop drones and that sort of stuff, you can guess why. That's pretty close to even in terms of the buys and sells. So people kind of disagreeing. Same with Tesla, which is also a very polarizing company. It's less polarizing these days. Nvidia, most people are buying Nvidia. There are some people selling it. And the point is that when it comes to individual stocks, you can see in the data that more people are trading. So there's 2 takeaways from this chart. Not that many people are buying direct US shares. And the second one is that when you compare it to ETFs, most of the time ETFs are just long-term buys and holds. And these other ones are a bit more buys and sells, if that makes sense. Now, specifically for US investors, I'll quickly move through this. I did make this cheeky little chart here. A designer probably wouldn't like this. But anyway, when you invest overseas from Australia, you really need to understand the tax regime, because the tax is not as straightforward. You can use a tool like Navexa, and you can add different investments in. So let's say Apple. I think it's going to search by ticker symbol. No, let's come back. Let's go to the overview page. Let's try Microsoft. Just going to push this in. No, it doesn't like me, Navar. All right, I'll come back to that. But anyway, let's do it on Perla right here. Stay logged in. Let's search for stay logged in. It doesn't like me. I'm just going to refresh this. Come on. There we go. Okay. Put my thumbprint in. Okay, let's bring up Apple. So here, it's probably because I wasn't logged in. Okay, so here on Apple, we can see people, if we go down, how many people actually invest in this. The number of the Perla community that invest in Apple is 1,300. We can see the average investment frequencies every 33 weeks. So it's more buy and just see what happens. The average investment amount is $800. Now, if we compare that to, say, the VAS ETF, which is a really popular ETF, if we scroll down, we can see that there are 16,000 people invested in this on the platform. The average investment frequency is 43 weeks. The average amount is 2,900, so substantially more. So people are really core in satellite portfolios over there. Jeremy said the tax slide has made me laugh. Okay, back to the taxes. The reason why I bring this up is even if you have a portfolio if you use a portfolio service like Navexa, like this, it will automatically track all your capital gains and it will track your income from those shares, right? Assuming, for example, that you say, for example, you in your Perla portfolio, just as an example, you buy the VAS ETF and then you buy Apple shares, those trade notes can be sent to Navexa. So that can all happen automatically, and Navexa will record the tax position on your based on your settings. However, what actually happens in real life behind the scenes is quite different. It's quite unique. You can see here on this slide that I've put together. Oh, Stuart, it's good to see you in the chat. And Kevin, love the show. Thank you, thank you, thank you. Human brains. Yes, Angie, our human brains aren't perfect. Anyway, you can see on this slide that there's US estate taxes. There's something called a W8 Ben form. I think it's actually W-8 Ben. And there's withholding taxes. You don't get franking credits. There's different regulation and there's a different reporting style. So in the US, they use GAAP accounting, generally accepted accounting principles. The rest of the world, literally the rest of the world, including Australia, IFRS. So just think of this is a picture of Australia. Whoa. Okay, so that's Australia. We use IFRS. The USA, which kind of looks like that, uses GAAP. And while the accounting principles are similar, if you're investing in individual stocks, you'll notice a few differences. So the two big differences when you invest in the US stock market, like you buy NVIDIA shares, is you get something called a 10K. The 10K is our equivalent of an annual report. So we call that an annual report. I'll just use AR for short. So we call it an annual report. But they also issue something else called a proxy statement. I don't know the actual code for this, but it's called a proxy statement. And it doesn't always come out at the same time as the 10K. What the proxy statement shows you is like about the management team, about how they're incentivized, about like those types of things, like what are the KPIs for the management team and the CEO. In Australia, that's all in one report called the annual report. They can still issue annual reports in the US, and many of them do, but it's still quite different. So if you're trying to research individual stocks on the United Stock Exchange, you need both of these reports, in my opinion, to make an informed choice. Another thing is that the reporting standards are a little bit different in the actual makeup of the financial statements. They're actually quite different. I would say the US is actually better. It's easier to understand. It looks boring as batshit, but it's actually much more detailed than the Australian style of reporting, which is more fluffy, and they put all weird types of asterisks in there. You don't get away with that in the United States. They throw away the key and you go straight to prison if you try to pull that stuff in the United States. Whereas in Australia, it seems to be a bit more loose. Another thing to keep in mind is that the USA does quarterly reporting for basically every company. In Australia, we only do quarterly reporting for small companies. And that's because they're typically speculative mining companies or biotechs. And the government has basically said, you guys are probably just igniting people's money. So you just need to tell us how much you've burnt in the most recent 3 months. Whereas in the US, you'll get companies like Apple, NVIDIA, Berkshire Hathaway, to a lesser extent, companies like Nike. These companies, they all give you quarterly reports, and they'll be good reports, and management team will answer questions. You typically don't get that every 3 months in Australia. You get that every 6 months in Australia. Okay, so that's some of the different reporting style, different regulation. You don't get franking credits from US companies, obviously, because franking credits is quite a unique thing to Australian companies. Another thing is the withholding tax. This can get extremely complicated, but what you basically need to know is you have to fill out the W8 Ben form to minimize the amount of withholding tax. And basically, it goes from 30% to 15% withholding tax. So if you are in, for example, a self-managed super fund, which was a great comment brought up by Bill here just a few hours ago on the Rask community, basically said, don't do it because it's complex. There are different variations of the tax forms, but in summary, even if it seems like you've just gone and bought Apple shares, woohoo, and your broker's made it super easy, there are tax consequences to that. So you should know what they are, because it may work out that after taxes are paid, it's not worthwhile for you. Now, I'll come back to this in just a moment, but that is a genuine thing you should be mindful of. It does increase complexity of your investing. The other thing, which hopefully none of us have to deal with anytime soon, is estate taxes. You may expose your portfolio to like death taxes, basically, in the United States. So hopefully we don't need to go into that now, but that's something that you should be aware of as well. So what are you actually doing with your money? It might seem like you're just using an online platform and things are all great, but you're actually exposing your money to different things. So you've got to be mindful of how these come together. For example, in Australia, with our stockbrokers, we offer something called HIN, holder identification number. That means that you legally own all of the individual shares. People know this debate. We've had it many times on Rask. Whereas in the United States, then this doesn't exist. This doesn't exist. Basically, in the United States, they use the custodial model, which is the kind of the world's model. And that basically means that a financial organization holds your investments for you, very well regulated. And what they then do is the brokerage firms get insurance. So they're kind of like all insured by like Lloyd's or one of the big syndicates. And the insurance is meant to tell you, hey, we're insured. If something goes wrong, our insurance would pay out and we'd be able to recover your money. So it's quite a different one to keep in mind. So Matthew Farry said, tax agents said we can claim the 15% as an offset, then pay taxes on the total amount. That's correct, Matthew. So there is a good ATO guide in terms of this and how to manage this. There is an ATO guide, and basically because the Australian government recognizes that you've already paid tax in the United States, you've just got to figure that out for yourself. And so it's more complicated, but it's not impossible. I hope that makes sense. Okay, so if I keep going down, this is the good question that Tash just said. Tash just said, VGS doesn't require W8 Ben form, it's Aussie domicile. That is correct, Tash. So if we keep going down, the tax form basically helps you minimize withholding tax, right? So this is what the form actually looks like when you invest in US shares from Australia. It actually looks like this, right? And some of the brokers like Pearler actually automatically fills it in for you. So it uses your information that you've given it and it will automatically fill it in, which is cool because it's the most boring form you've ever had to create and fill in your life. And it's pretty daunting too because the instructions online aren't that great. So basically what happens in Australia is most people, when they buy individual shares, so say this is URI, if we take this form and we fill it in, and that form is held against our individual name. So when we go and open our brokerage account and we buy US shares, like NVIDIA, the form is basically in the United States recognizing us as individuals, right? Now, there's a thing here that happens, right? This form applies to the investments that you're making. And one of the things that makes it really cool is that you can then take this form and it doesn't have to go to you as an individual. This form can apply to a company, a self-managed super fund, like a trust. It can apply to an ETF itself. So a good example of this is everyone probably knows this ETF or has seen it somewhere. So if we go back into our Navexa platform, let's have a look. What is it? VTS. I'll go here. VTS, right here. And you can see here this ETF, right? Now, most people know this ETF and they know what it covers. It covers the United States stock market. So the entire United States stock market. You can see that in the name, US Total Shares Stock Market ETF, right? Now, what actually happens realistically is your money, when you invest in this ETF, even though it's an Australian ETF, what actually happens is this. Get this little guy out of the way for a moment. So what happens is your money goes through the ASX. How do I know this? So it goes through the ASX. The reason I know this is because here on the Pearler platform, it will say it's an Aussie. If I type it into the thing, you can see it right here. It's got Oz on it. That's an Australian thing, means it's on the Australian stock market. It doesn't have a US flag next to it. That's not the only way I know, but I read it. You can read it in the PDFs. So your money goes there to the ASX, and then it goes to Vanguard, right? So Vanguard manages the ETF. This is just a simplified version. So Vanguard gets it. But actually, what's happening here, even though it's an Australian ETF, so even though it's here in Australia, it's gone through the ASX, this is actually an ETF that exists. What does the United States flag look like? Something like this. This is actually, it's got a bunch of stars, a United States-based ETF. So this is on an Australian stock exchange, but for tax reasons, it's a US ETF. That's one of the reasons we don't invest with it at Rask. It's probably the most obvious reason most investors do not use this ETF, because you expose yourself to all of these tax consequences, even though it's an Australian listed ETF. I know this is quite complicated, but I wanted to cover this off. So what most ETFs do, you're like, well, what? This doesn't make any sense. So what most ETFs do is when you invest via the Australian Stock Exchange, you get an Australian ETF. So let's just say you go into IVV. This is an ETF that's here in Australia. And what actually happens is the W8 Ben form is filled in at the ETF level. So this tiny little thing, I probably zoomed in too far. This form is actually filled in by the ETF or fund manager. And then your money is invested in an overseas way, whether it's in another ETF or whether it's in the shares, like the US shares, like Nvidia. That's how it works. So that the tax component is actually sorted here. So when happy old you over here, Phil, go and invest in your IVV ETF, you don't actually have to worry about it because it's already happened for you. And I think that makes sense. I hope that makes sense for people. So that's one of the reasons. But people think these are two really popular ETFs. They think that just because they're in Australia, that they're for tax reasons, they're Australian. They're not. Vanguard could, I don't know why, but Vanguard could solve this, I believe, if they wanted to. I don't know why they haven't. I should ask them, but they could solve it. There's probably some reason why they haven't done it. But and the ETFs are fine, like in terms of generally, like they're safe, they're secure, they're all that. But I just wanted to bring that up. And so this is where the tax becomes obviously a bit of a headache for people. I've got to be quicker here, Owen. So another reason that people do or don't like, depending on your perspective, don't like to invest overseas is because of the fluctuations of the currency. On the podcast this morning with Drew Meredith, it goes out on Saturday morning, the Australian Investors podcast. He made a reference to a particular period in Australia where the Australian dollar went from here to here. So the Australian dollar went from around 50 cents in the early 2000s up to $1 in the late 2000s/2010. Now, what happens is the currency obviously fluctuates through time and changes your return as an individual investor. And what actually happened throughout this period is even though the US stock market went up, people investing from Australia didn't see nearly as many gains because they were getting negatively impacted by the currency. Because remember, if the Australian dollar goes up, effectively what it's doing is it's saying, like, over time, your dollars are going to be worth, like, you're worth less, basically. But the opposite happens on this angle. So people who invested in the US stock market at this time and wrote it down, if they had bought in at $1 and now the currency is 67 cents, it means that they've benefited because their $1 in effect can now be traded back to Australian dollars for a lot more. And so currency can actually put people off. But there's another reason why currency can work to your advantage or against you. Most people don't talk about this when they choose US brokerage accounts. And one of the big things is that when you use a brokerage account, like say Perla here, and I don't know where it would be, but a lot of the brokerage accounts actually make their money when you transfer money back and forth. So it's pretty simple for most people, but it's worth understanding is that if you say want to buy US shares, you have to buy the shares in the US dollars, right? The currency that they're in. So you need to transfer your Aussie dollars to your US dollars. And this isn't like when you go to London for a family holiday or something crazy like that, when you know the currency that you're getting and you actually get the money in your pocket. This all happens behind the scenes. And even if the real currency rate is here, so let's just call this FX, foreign exchange. what they'll do is they'll offer you, they take a spread. So they might offer, they might buy or sell at a different level. So they might offer one investor this amount right here, and then another investor this amount, and they make the bit in the middle. Now, this is really important to understand because many of the brokers make their money this way. And most of them quote this spread in a different currency, or they make it really deliberately confusing to you. There is one broker in Australia that, off the top of my head, quotes its currency conversions something like this, 0.7, but not percent, it's 0.7 bips, which is an industry standard way of explaining it. But what they say is 0.7 or 0.7%. So 0.7. So if the currency was 67.51, the 0.7 would come off that, right? This is important to understand because if the currency is so low, depending on how they quote it, that could be a lot in fees. Like all of us here are worried about brokerage fees and ETF fees and all these other fees that we seem to be worried about since reading the Barefoot Investor book. But realistically, the lower the currency goes, the bigger the percentage of your overall investment that makes. And if the brokering firm that you're dealing with is incentivized because they make money this way to keep your money transferring back and forth, they're going to constantly try and tell you to do that. And so that's something to keep in mind. Kevin, you said worked out on Stake that they charge you 4 times for one US trade, transferring the cash twice and fees for trade in and out. So, well, that's interesting, Kevin. I'll let you say that, not me. But you get what I mean. That's one of the things to keep in mind. So what you can do is just look for brokers that make it very obvious what fees you're paying and how you're paying them. For example, some of the brokers also quote their fees for brokerage in US dollars and some of them quote it in Australian dollars. Anyway, let's get to a stock checklist and one of the investors that I would highly encourage you to go and follow. It's a shame because if you're new to him, you will be learning about him as he's choosing to step away from investing full time. So hedged or unhedged, Steph? That's a good question. We actually created this chart on our Rask Media site. We actually created this chart. Where is it? And I'll pop it in. Why is it not coming up? I'll pop this in the live chat now. But we created this chart, and this is probably about as technical as our charts get at Rask. This is like enough gobbledygook for me for a year. But basically, what it shows you is the long-term moving average, so the average over time of the currency in the orange line, and it's updated every day, every few minutes. And then the green line shows you a few standard deviations, so the natural range that the currency might move in through time. And the reason that we use this is a lot of professional investors use this same type of chart to understand the longer term arc of where currencies might be moving. And if you go to the maximum amount of chart, you can see how the Australian dollar has moved to the US dollar. Now, for us in our portfolios, right here, for us in our portfolios, I said this in the email before. If you click on asset allocation, so in our portfolio, we have about 50. This is our high growth option. We have 50% invested in international shares. Some of that is emerging markets. And then there's about 40% in US shares. And of that 40%, off the top of my head, 10% is hedged. So 30% unhedged, 10% hedged. And the reason is you don't have to hedge all or nothing. And that's important to understand. There's no particular rhyme or reason. All of that really good academic literature or like industry literature on whether or not to currency hedge is actually written from the perspective of superannuation and pension funds. There's very little in the way from actual individual investors like us, or even the professional investors, like say us at Rask, that have actual people's money to manage. It's normally for when people and academics write about what's the best for people. Typically, they do it from the perspective of meeting pension obligations, like paying out pensions over time and stuff like that. For the most part, though, my kind of conclusion over the long term has always been that it's something that people shouldn't overthink and just have a little bit of exposure to everything because, we talk about this on the Investors Podcast quite a bit, where we say that um, you don't want to prepare for a certain future. You want to be prepared for any future. And when you build a portfolio, you don't want to invest all or nothing in something just because you had a strong view and then it turns out to be wrong. That's just your future's not worth that. So this guy here, David Gardner, is someone that I hope you can walk away from today and remember. He still runs the podcast called Rule Breaker Investing. He is, in my opinion, probably the greatest, I'll say it, he's the best investor that I've seen anywhere in the world over the past 30 years. And his style of investing is very, very unique, very, very what traditional finance would call high risk, very high risk. But he's got a track record to prove it. He's co-founder of the Motley Fool, so he's helped probably millions of other people understand his perspective of investing. And he runs this weekly podcast that you can check out. He's very much kind of like in the different phase of his investing journey now, where he's less focused on stocks and more focused on life in general. But anyway, so stock checklist. This is our stock checklist at Rask. It's the same one we applied to stocks that we apply to Aussie stocks. This idea of a circle of competence is like investing in things that you can understand. So a good example of this is at the very top of the show, Jenny asked about NVIDIA. NVIDIA being the GPU business, probably the most talked about stock in the world right now. It's also one of the most traded stocks in Australia, but probably around the world right now as well, which we saw here. We saw that right there. And at the very top of the show, I shared a quote from Warren Buffett. He said, the difference between successful people and really successful people is that really successful people say no to almost everything. And I mentioned how most investors that I come across have got really good at making their investing simple. And so if you think about it, what I've tried to illustrate through all of this stuff is that you could go and invest in individual stocks in the US because that's where the exciting companies are. You could learn about different accounting principles. You could speak with your accountant about how you minimize foreign tax paid. You could make sure that you fill in the W8 Ben form every 3 years. You could try and manage the currency yourself and make a really good bet. You could try and pick a brokerage that has the right amount of insurance and regulation and doesn't have any weird things going on the inside. And you could pick one that is using the right custodian and actually discloses their sub-custodian list to you. And you could try and find good stocks on top of all of that. Or you could say no. And you could stick within your circle of competence and just buy ETFs that do it for you and fill in and do all the tax stuff for you. You could do that too. And that's probably where most of us will go in the end because it makes sense. But if you're like me and you're a little bit free-spirited and maybe you got a little bit of crazy in you, just like me, you might want to go and buy individual stocks because I like it. And if you're going to do that, you probably still want to be in your circle of competence. So if you don't understand what a business does, don't invest in it, right? And if you want to find businesses for the long haul, we talked about this 2 weeks ago in our live show on investing in stocks. In Australian stocks, you want to find companies with durable competitive advantages. Companies like Costco that have the lowest prices and the best experiences. Companies like Amazon that have the best logistics network in the world. Companies like Microsoft that have the best cloud computing and ecosystem for business customers. You want to invest in Apple that has the best software for devices like this run right here in front of me. You want to invest in those businesses. Not the businesses that are mediocre just because they look cheap, right? You want to look for those businesses. Another thing is you can look at management teams that are aligned and transparent. One of the best CEOs that I've ever come across is a guy called Todd McKinnon. Now, he's a super smart software engineer, and I used to own these shares in Okta, but if you tune into a quarterly management call with the management team of Okta, you can hear how they talk and how honest they are and how transparent they are. Another great example of management teams that are like super transparent and aligned is this company, Mercado Libre. This company is like the Amazon of South America. That's how it's kind of built. And you can see the performance of this over time. It's now $2,000 US a share. I'm going to go out on a limb here. I think when David Gardner first started buying this, it was $40 or less. I'm pretty sure it was maybe even far less than that. I don't know if this is adjusted or not. But this is the type of business that's available to you in the US. And you can use all of these same tools. And to do this, you would be looking at the proxy statement and the 10K. Whereas in Australia, you would be looking at the annual report. Competitive advantages, if you want to look for companies with good competitive advantages, look for a figure called the ROIC, return on invested capital. Circle of competence, only invest in businesses where you actually understand their products. This is not a knock on Jenny in any way. You know, I'm a huge fan of you, Jenny. But even as someone who studied technology at university myself, trying to still wrap my head around exactly what NVIDIA does to the GPUs to make them more special than AMD GPUs is like, you know, I've been following this company for probably 5 to 7 years now. I've got a pretty good understanding of it. I don't own shares other than through an ETF, but it's still on the edge of my circle of competence, if I'm being really honest with you. I would much rather invest in a company like, say, Microsoft, because I actually understand the products, even though they have the big OpenAI/artificial intelligence thing, which is quite out there. I can still kind of understand that better than I can understand the design of GPUs. The next thing is structurally growing industries. One of the beautiful things about US companies is that because the American lifestyle and economy and everything about it is such that it dominates global defense, it dominates global trade, it is the globalization hub, it has the most influential politics in the world. Because of all of those things, what happens, and their economy is huge, is a lot of big US companies can win the US market, and then expanding overseas isn't as difficult for them as it is for an Australian company which wins in our little pond and then tries to go overseas. A lot of companies around the world struggle to make international expansion, but US companies in particular have a better go of it because they have a massive foothold on the global stage and it makes it easier for them. So, for example, you want to be able to invest in companies with strong and structurally growing and increasingly important sectors. A good example of this is a company called Home Depot. Some of you will know Home Depot is basically Bunnings of the USA. It's just think of it like that, right? But if you look at the chart of this company through time, it's gone from 33 cents to $370, or it's up 112,000%. Now, if we look at Wesfarmers on the ASX, one of our best performing companies, it's up 670%, not over as long period. But the difference is that Home Depot in the US can just be in the US and Canada and grow enormously without even leaving its own country. The difference is that now Bunnings in Australia is probably getting towards the mature point of its cycle. So you can capture these businesses earlier in their journey if you know how repeatable their business model is and if they're in one of these structurally important sectors. Obviously, in the US, like there's a big DIY and trades market as well, and population growth. Finally, can you value the shares and can you get them on a reasonable valuation? One of the things that's really important and really great about US companies is that they disclose the things that investors want more readily. So in Australia, you've probably heard people talk about something called free cash flow, which is this metric that basically tries to estimate what a company is producing in actual cash, rather than profit, actual cash, right? Well, this, if you go online and you Google free cash flow, in fact, why don't we do it now, right? The first thing that comes up is it's basically, it shows you a formula. So free cash flow, FCF, how to calculate it and interpret it, right? And if you go and you follow all of these steps, you're like, I get it. And then you try and apply this to an Australian company, it won't work because the way they report is slightly different. So you can do these things and you can still calculate them, but it requires a little bit more of an understanding. Whereas in the US, the way they report is in line with a lot of the education online. So in that sense, it probably makes more sense and it's easier for you to put together. But still, you want to invest in shares at a good price. And one of the things that happens when a lot of Australian investors invest in the USA and they do their valuations on their companies and their stocks, is that they forget that that's in US dollars and we're in Australian dollars. And so the currency impact also has an effect on the final return that you get. Whew, okay, now I can draw breath. Effectively, what we've gone over is that the US market presents a huge opportunity for investors. You can buy shares from Australia using good brokerage accounts. There's been a few that have mentioned. I showed you how Perla does it all in one platform. Comsec does it. That was another one mentioned in the discussion. Interactive Brokers by Josh mentioned. There's many different. I could go on and on and on. But the reality is, if you do choose any broker, make sure you know where your money is held, how that company that holds your money is insured, and make sure that you're prepared for the slightly more complex actual realities of investing in direct US stocks. Remember, you can get all the goodies in the show notes, and you can see like the Perla, we don't make anything from it, Navexa, Pocket Smith, the Super Guide, which will, when it comes to talking about retirement in a few weeks, we'll bring them on. And you can also access all the free courses on Rask Education. Now, I know we've covered a lot of ground, and it was pretty gross and technical, but this is the foundation episodes for what sets the scene for what we'll build over the next few years. So please, we've got a little bit of time now. The last Rask Invest Live went for an hour and 35 minutes. We probably don't need to go that long, but because I'll be back next Thursday, of course. Kevin says you can buy ETFs for free with CMC markers, as it's free for trading under $1,000. So you can just keep adding for free. Yeah, I have a very big gripe with CMC markets, Kevin. They offer CFDs, which are called contracts for difference, which is probably the most disgusting form of finance I've ever come across. And so I do not in any way like that platform, and do not in any way like CFDs, and they should be banned in Australia. And that is all I'll say. And that is why I do not have a favorable opinion of that. Clary, you've said, okay, you said, yes, following on from so you were the one that posted this earlier on, and we did answer this, the reason why there was this change. So thank you for posting this. I said that earlier on in the show, I said that there's many reasons why these can change. In this instance, it could have been licensing. It could have been a change to many different things. But the reason the ETF N100 changed to U100 could be a bunch of different stuff. Pubs did note in the community that the CEO, Evan Metcalf, wonderful person, has stepped down from the role of CEO. It's important to understand Evan had been with the business for a very long time. And so him stepping down is not necessarily something to be alarmed about. Same with Cliff. Like, I don't think it's necessarily anything to be worried about. I'm not worried about that. And in terms of the ETF changing, you did a really good thing here in that you actually just went through and looked at the individual investments and saw what was actually included in them to see, is this ETF that different? Obviously, when an ETF provider changes the rules of an ETF, even though it might not be immediately apparent, over time it might move away from what it is now. So that, part of me, could happen with U100, but I hope that makes sense. Okay, so Otto, you've said, hi Owen, does the capital gains tax discount applicable to US stocks? Yeah, as far as I know, Otto, yes. Vishal, you said, do ETFs reinvest the dividends? Vishal, the answer is that it's actually quite technical. It actually depends. So with ETFs, you can select to have dividends reinvested, just like you can with a share, where you can do dividend reinvestment plans. You can do a distribution reinvestment plan. You set that up at Computershare or Link Market Services or wherever your share registry is. The important thing to understand with ETFs is sometimes they're not as tax efficient as some other things, but sometimes they are more tax efficient. So what I mean by that is inside of an ETF, shares will be bought and sold, and that will create tax events. So that's why it's best to use a platform like Navexa or ShareSite that can adjust for some of those things. And I was chatting to Navar this morning, who is the founder of Navexa, and he was saying how so many investors are doing their tax returns right now for ETFs, and they're probably doing them incorrectly. And I'll show you what this looks like, because he put it up on our YouTube channel the other day. Not on our YouTube channel, sorry, on our community. So Navar actually talked about how, and he did a free video, so I'll pop this here. just like that there. So you will see that he talks about how investors now with ETFs have to make adjustments to their cost base when they do their tax return. So I'll leave that there, but go and check that out. Kevin, you said don't have to buy CFDs, mate. No, totally, mate. You don't have to buy CFDs. And for what it's worth, I used to use CMC markets back in the day. I just don't anymore. And for me, to be honest, I don't really care about an extra $2 or $3 to buy ETFs with a brokerage fee, to be honest. You know, obviously that's the Rask philosophy in general. It's our whole community is like that. So, yeah, it's just I think we're as an industry. I think finance has done a pretty good job in a roundabout way. I could say a pretty good job of getting to the bottom of the fee race. I don't think many investors want to always pursue the lowest fee thing anymore because I think that comes with a few other consequences, and many of those consequences are a reality. Like we spoke, I think it was last week or the week before, about how some brokers in the past had collapsed. Not CMC markets in this case. Obviously, I'm sure their CFD trading part of their business is way too profitable for them to collapse. But there are some brokers in Australia who I wouldn't trade with simply because they don't have a viable business model. And I would just want to have a HIN-based broker and I'd happily pay a transparent low-cost fee. I hope that makes sense. It's not necessarily like any issue with the shares side of CMC. It's more the CFD side. So that's what I believe. Okay, so the QA, you've said, should we start listening to David Gardner from here onwards, or are there some other specific episodes that are a must listen from his episodes? I'll actually call something out for you, QA. That's a great question, actually. David Gardner, invest like the best companies that break the rules. So this is probably one of the greatest podcast episodes I've ever listened to anywhere. This episode right here. In fact, if you go, so I'll show you something. Not that one. I want this one. So if you were to go into our value investor program and you were to go to, I think it's this one, rules of the game. It's not in here. I don't know where it is. It's somewhere in here, right? I talk about this. David, this podcast from David Gardner being interviewed by Patrick O'Shaughnessy is probably one of my favorite of all time. It's from 2017 and it takes you step by step through David's process for picking stocks. So this is not his podcast, but it's a really good overview of how he picks individual companies. What else have we got? Okay, so there was two extra questions. Matthew, you've said this again. Sorry, mate. Would it be wise if building a dividend-based satellite portfolio to add US shares like SCHD and O to say VHY to diversify your risk? Yeah, sorry, mate. SCHD ETF. So US dividend equity ETF. To be honest, just as a general rule, Matthew, just as my 2 cents, obviously everyone's different. I actually don't see the US market as a source of dividend income. I just don't, because of the tax advantages of Australia, because of the tax inefficiencies of the US, because of the less than optimal conditions for US companies to pay dividends. I don't do that. I think there's enough income to be harvested from Australia, capital gains sold overseas, that I don't need to use a dividend strategy in the US. I know that's quite different, and each their own, but I just don't do it. There's a lot of good people. What a lot of people would say is that there are a lot of good dividend ETFs in the US. For example, Invesco has, I think, JP Morgan has one of the most popular of all time, but still, it's not something that I necessarily think we need in our portfolio. But I can see why a lot of people do it. So fully get it. I just think there's better tax advantages of using an Australian position. I don't actually know this. So real estate investment trust. Okay, yeah, sorry, I don't really know this one either, Matthew, so apologies. But if you have some links to like a good analysis of this, chuck it in the chat, and others can go and peruse it at their own leisure. Again, like for income-focused things, there are certain. When I look for passive income and income streams for our investors, I think not just of the income stream itself, but the after-tax income stream, the after-tax, after-cost income stream. And for a lot of investors, it makes sense to have franking credits and Australian-based income streams. Now, that's not entirely for everything. Like there are obviously, if I was to go for a REIT, for example, we don't actively use REITs in our portfolio, and there are many reasons for that, particularly with where property valuations sit and interest rates sit at the moment. It's quite interesting. Some might say really concerning. But when we invest in individual funds or stocks or whatever, we have a policy that we apply. I'll bring it up. It's called the best expression policy. I'll show you. This is what it looks like. It's on our website if you want it. But it's this idea is when most people make investment decisions, this is the way their logic flows. So most people know that there's like 2,000 shares in Australia, there's 10,000 in the United States, there's a heap of REITs, and there's a heap of different ETFs you could invest in. And obviously, when there's so many different choices, what do people do? They try and narrow it down. It's like when you have 10 different variations of baked beans, you might just go with the one that you trust, or you might go with a few brands that you know. That's advertising 101. In stocks, the way we do that is we use rules. So we say, I only invest in Australia, I only invest in the USA, I only invest in high dividend stocks, I only invest in growth stocks, I only invest in whatever the case may be, right? And so we take that and then we filter the stock market, and then we get down to another decision layer where we might be like, okay, now I've got these 4 dividend ETFs. Which one of the 4 has a higher dividend yield and has been more consistent with the dividend payment? Okay, go to the next layer. All right, now I've got a dividend ETF and I'm comparing it to my favorite REIT, and which one makes the most sense? And then you get to here. What happens is that a lot of people, when they think this way, it's kind of like linear. You move through the decision-making process and then you have an option at the end. And a lot of people get stuck in something called sunk cost bias or commitment bias. And so what we try and do at Rask is we try and say at any time we should ask ourselves, is this the best expression of what we want? Because a lot of people get lost in it. They read a news article, they listen to a live show like this, and they say, oh, sounds like that, USA investing thing's not the greatest idea. But it might be for some people, right? So what we try and do is once we get through and think that we know something, what we then try and say is we step back and we say, is this the best expression? Is this the best thing that we could do, regardless of anything else that we've thought of before? And a good example of this is like, if you get to the end of your research and you go, you know what, that REIT, that real estate investment trust, pays a 4% dividend. It might grow at about 2%, 3% per year. That's a 7% return over the long term. Then you think, hold on a second, 7% return? The stock market's done 9% overall. Maybe I should just do that. And a lot of people don't do that because they get so far down their decision-making tree that they forget to see what they're actually doing. And they ultimately end up committed to something before they've even purchased it. And so what we try and do is really emphasize this idea of if you want growth, if you want income, or you want a bit of both, what is the best way to do that, regardless of what you believe? And for most people, it's really simple stuff. It's like, just go and buy an ETF. Just go and buy a credit fund. Just go and put the money in a term deposit. And that's what I meant at the top of the show when I said before that most people end up with really simple investment strategies that do them the world of good over the long term. And it tends to be the case with us too. I can expand on that in a few weeks' time. We've got a couple of episodes coming up that show people how to actually build a portfolio from scratch. And I hope that rant had some semblance of sense to it. Finally, Owen, thanks, Kevin, for all the questions, by the way, today, mate. Really appreciate it. Do you think it is wise to follow a dividend strategy in SMSF due to the franking credit, the benefit of franking credits? Yeah, I think so. Yeah. So franking credits, Kevin, franking credits are really good because they're credits, right? They're not just offsets. They can also be refunded. So it doesn't really matter what type of investor they are, like as in what legal structure it's held in, as long as someone holds investments and is legally eligible to receive franking credits, like foreign income. Foreigners aren't eligible to receive it, nor are day traders. Day traders actually can't claim franking credits because they don't meet the at-risk rule, which is a 45-day rule. So this is interesting for people to know. If you go and try and buy a dividend stock before it pays a dividend, thinking that you're going to get franking credits and then sell it a week later, legally you're not actually entitled to those franking credits. So that's another reward for being a long-term investor is the franking credit rule. And you just can check the ATO website. So I would just say just generally that franking credits should be utilized for anyone seeking passive income. It's a massive free kick. Yeah. Matthew, yeah. Thank you, mate. You always bring good questions. And apologies I haven't got to SCHD already. I know a lot of investors that use that ETF. We don't use it, but I know a lot of investors do, particularly US-based investors. So nothing wrong with suggesting we take a look at it. So thank you for that. All right, Raptor, last question, mate. Good question. So yes, absolutely. This is a wonderful question. You say, Raptor, Australian share growth charts exclude dividends. We actually covered this 2 weeks ago. Is there a way to look at AU share performance inclusive of dividends? I'm looking to compare them to US stocks, which are more growth type. Absolutely. Let me show you this. We covered this a few weeks ago, mate. So most people in Australia, they just look at the ASX 200 XJO. Let's zoom in there. XJO. I almost never look at this chart. What you want to do is, if we go finance, what you want to do is you want to compare it to the ASX 200 net. Let me just get rid of that. S&P-ASX. You want to compare it to XNT, my friend. XNT. And you can see that if you include dividends, which is the yellow one, look how much better it has performed over 5 years. Almost double the return. There is another one that you can use, Raptor, that also shows franking credits. I don't think Google Finance picks it up, but you can find it on the S&P website. So it shows not just dividends, but also the impact of franking credits. And it's even higher again. It's another thing that people don't really talk about, but over 20 or 30 years, it will make a hell of a difference. Jenny, I didn't get to NVIDIA, but I do apologize. You know you can ask me anytime in the Rask community. So just jump over there. Otherwise, just drop me an email. In short, NVIDIA, great company. I just don't understand it as well as some other investors. So as good as it might be, I like to just sleep a bit easier. I am going to start buying US shares and I might revisit NVIDIA. But yeah, for the most part, while we're still building our core portfolios, it's not that much of a focus. I'm sorry. All right. Thanks, Tash. Thanks, Kevin. Thank you, everyone. We'll be back next Thursday. Don't forget, next Thursday, we'll be back. And as we progress through time, we will start to dive into really interesting companies, really interesting ETFs and funds. We'll have some expert guests on the show. We've got property next week, and then we go back to our portfolio. And what I really need from everyone here is to submit some ideas, ETFs, stocks. We're going to start building our core portfolio and our satellite portfolio together, using Navexa to track the portfolio. I don't know what we'll call it. Maybe we'll call it the Donald J. Trump portfolio, or just have a bit of fun with it. Remember, we're going to build this portfolio together over the next year and then set it free out into the pasture. And the next year, we'll build another one and set it free and track it over the next 5 years. And we'll just see how they go. Now, obviously, though, that these fund portfolios that we build together are different to the actual portfolios that we build at Rask. But yeah, it'll be a bit of fun. So come back. That's in 2 weeks. Next week is property. Thank you so much. Good to see you, Stu, Chris, Paul, Kasim, everyone. Thank you so much. We'll be back next Thursday. Don't forget some great podcasts on the Rask YouTube channel. That's it for now. Have a wonderful rest of your Thursday.